Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in the financial world. And today we're diving into Goehring Rozencwajg Investments Fund's annual report, which dropped on August 7, 2025. Get ready because this report tells a tale of ups and downs in the natural resources sector, and we are going to break it all down for you. Before we dive in, if you love getting straight to the point insights from these massive filings and want to understand exactly what companies are doing financially, make sure you hit that subscribe button and the notification bell so you never miss a video. Also, we have a fantastic community over on Discord discussing these very reports. Link for that is in the description below. Alright, let's get right into it. This report covers the period from June 1, 2024 to May 31, 2025 for the Goehring Rozencwajg Resources Fund. The fund itself paints a picture of a challenging year for natural resources. They mention that compared to the MSCI World Index, which is a broad measure of global stock markets, the fund didn't do so well. But when you look at benchmarks specifically for natural resources, their performance was actually quite good. They highlight that the Goldman Sachs Commodity Spot Index dropped 8.5%, and natural resource stocks measured by the S&P North American Natural Resource Sector Index were down 3.8%. Our fund, the Goehring Rozencwajg Resource Fund, saw a decline of 2.5%, and natural resource stocks measured by the S&P North American Natural Resource Sector Index were down 3.2%. They highlight that the Goldman Sachs Commodity Spot Index dropped 8.5%, and natural resource stocks measured by the S&P North American Natural Resource stocks measured by the S&P North American Natural Resources, their performance was actually quite good. They highlight that the Goldman Sachs Commodity Spot Index dropped 8.5%, and natural resource stocks measured by the S&P North American NAP. The big reason for this relative strength was their focus on gold stocks. Gold prices shot up 40% during this period, and gold stocks followed closely with a 45% increase. They also benefited from an overweight in platinum group metal stocks, which also saw good performance. On the flip side, there were major drags. Uranium mining stocks took a big hit, falling about 28% because uranium prices dropped 20%. Also hurting were the energy exploration and production stocks, primarily natural gas related, which pulled back with the overall weak energy market. Now let's look at the money for a hypothetical $1,000 investment starting in 2016. The report breaks down how it grew or shrank each year. For the institutional class of the fund, an initial $1,000 investment in 2016 grew to $119.51 by May 2025. This represents an average annual return of 6.07% since its inception. In comparison, the MSCI All Country World Index for the same $1,000 investment would have grown to 241 to 24, once it's 74 at an average annual 5% since inception. And the MSCI World Index would have seen that $100 investment grow to $253,992.89 also, with an 11.70 times average annual return since inception. This clearly shows the fund underperformed broad market indexes significantly. Looking at the average annual returns for just the last year, the institutional class returned a negative 2.47%. The MSCI All Country World Index returned a positive 13.72%, so the fund definitely had a rough past year compared to the broader market. Let's look at some key numbers for the fund. The total net assets stood at a significant $469,959. The fund held 82 different investments. The portfolio turnover rate was 24%, meaning they bought and sold about a quarter of their holdings during the year, which isn't excessively high, but indicates some active management. And importantly, the advisory fees paid for the year amounted to $259,869 at about 0.5% of the total assets, which seems reasonable for fund management. Now, what was the fund invested in? Let's break down the sector weightings. A massive 32.9% was in energy, and an even bigger chunk, 62.4%, was in materials. This heavy concentration in natural resources is the core of this fund. They kept a minimal 0.9% in cash equivalents, and other net assets. Digging deeper into the industries, metals and mining made up a huge 42.0% of the fund, followed by oil and gas producers at 24.4%, and then oil and gas services and equipment at 8.5%. This confirms their strong bet on the commodities sector. Geographically, where were these investments located? Canada was the top spot, representing 44.4%. The United States followed at 36.9%. then South Africa at 7.2% and the United Kingdom at 6.6%. This shows a significant weighting towards North American resource markets. In terms of what kind of assets they held, a vast majority, 96.3%, was in common stock. They also had 2.8% in mutual funds, but a very small 0.0% in rights and warrants. The report notes there have been no material fund changes during the reporting period. This means the strategy and holdings remained largely consistent. There have been no changes in or disagreements with the fund's independent accounting firm. This suggests stability and continuity in their auditing process. Moving on to the Code of Ethics, the report states that the fund has adopted one that applies to its key officers. This is standard practice designed to ensure honest and ethical conduct and compliance with laws. On the audit committee front, they have an expert designated Edward O'Brien. The board has confirmed he has the necessary financial skills and is deemed independent. Let's talk about the auditors. For the year ending May 31, 2025, the audit fees paid to the principal accountant were $43,500. Audit-related fees were zero, tax fees were $7,000 covering tax compliance and advice, and there were no other fees. The important takeaway here is that all services were pre-approved by the audit committee, which is a good sign of oversight. Now on to the meat of the financial statements. The schedule of investments gives us a clear look at what the fund actually holds. In the energy sector, under oil and gas producers, they held Antero Resources Corp. With a value of $16,521 and $581.5. Another significant holding was Range Resources Corp., valued at $28,930 and 219 port. In the materials sector under base metal, Cameco Corp was a notable holding worth $20, $490, and $416. Nutrien Limited, another materials company, was valued at $25,180. And within the broader metals and mining category, there were numerous positions like Alamos Gold Inc. at $16,500 and $644 and Siboney Stillwater Limited at $10,900, $52,329. Interestingly, they also had a substantial holding in the Sprott Physical Uranium Trust valued at $13,200, $45,281. This aligns with their commentary on uranium exposure. The country composition as of May 31, 2025 confirms the geographic breakdown, with Canada at 44.44% and the US at 36.9% being the dominant regions. Looking at the statement of assets and liabilities, we see the total investments valued at $469,310, $641. Liabilities were relatively small, with the payable to advisor at $247,462. The net asset value per share for the institutional class was $13.99, while for the retail class it was $13.79. The statement of operations shows the revenues and expenses for the year. Investment income came largely from dividends totaling $5,485.185 and $158. The main expense was the investment advisory fee at $3,670 and $518. They reported investment advisory fees waived by the advisor for the institutional class were $1,002 and $537. This is a crucial detail indicating the manager voluntarily reduced their own earnings to help the fund's performance. This resulted in a net investment income of $1,198,240. However, the big story is the net realized and unrealized loss on investments, which was a substantial $10,200 and $355,767. Ultimately, this led to a net decrease in net assets resulting from operations of $9,037,527 The statements of changes in net assets further elaborate on this. For the year ending May 31, 2025, the net increase or decrease from operations was negative $9,037,527, a stark contrast to the positive $87,050 from the previous year. On the shareholder activity front for the institutional class, shares sold were 169,063,955, but shares redeemed were 101,283,816. This resulted in a net increase of 7,841 tons 759 from share transactions. For the retail class, shares sold were 12,581,396, with 6,979 redeemed, resulting in a net increase of $6,580 and $752 in shares outstanding. The net assets at the beginning of the period were $408,041,576 and grew to $469,755,900 by the end of the period. This growth in assets, despite the net loss from operations, was purely due to shareholder activity, meaning more money came in from new investments than went out, offsetting the poor investment dollars. 67 net loss from operations was purely due to shareholder activity, meaning more money came in from new investments than went out, offsetting the poor investment performance. Let's look at the financial highlights for the institutional class. The net asset value at the beginning of the period was $14,189. It ended the period at $13.99. The total return for the year was a negative 2.47%. This confirms our earlier performance discussion. Net assets at the end of the period were $435,535,155. The operating expenses, including reimbursement or waiver, were 0.92% of average net assets. This shows the impact of the fee waiver mentioned earlier, keeping the expense ratio relatively stable. And for the retail class, the net asset value began at 14.70 cents and closed at 13.79. The total return for the retail class was a negative 2.76%. Net assets here were about $34,221,000. Their operating expenses, including waivers, were 1.25% of average net assets. This higher expense ratio for the retail class is typical. The fund is part of the Goehring and Rozencwajg investment funds, a Massachusetts business trust organized in July 2016. Its investment objective is to maximize total return through income and capital appreciation, concentrating in natural resources companies. When it comes to investment valuation, the fund generally uses market prices from exchanges or approved pricing vendors. If market prices aren't available or reliable, they use fair value procedures. Investments valued using level 3 inputs, which are significant unobservable inputs, represented zeroed their investments as of May 31, 2025. This is a good sign, as it means most of their assets are valued based on readily available market data. For tax purposes, the cost of investments was $464,572. And the net unrealized appreciation was $69,246,072. Looking at securities transactions, the purchases of securities for the year were $170,55,173, while the proceeds from sales of securities were $96,548,340. This shows a net investment into the fund's portfolio during the year. Under management and related party transactions, the fund pays its advisor, Goehring and Rozencwajg Associates LLC, an annual management fee of 0.90%. As we saw, the advisor also agreed to limit total annual operating expenses to 0.92% for institutional class and 1.25% for retail class shares. Crucially, the advisor chose to waive or reimburse over $2 in 4051,072 in 4051.9 to be exact. This is a strong signal of commitment from the management team to support the fund, especially during a tough performance period. Now for the risks. The report details several. Commodities risk is significant given the fund's mandate. This means commodity prices can be extremely volatile and swings can significantly impact the fund's value. Natural resources investment risk is also key, as performance is tied to supply, demand, political events, environmental issues, and of course commodity prices. And the fund acknowledges its concentration risk, meaning being so focused on natural resources makes it more vulnerable to downturns affecting the entire industry. The geopolitical risks like trade wars and global instability are also highlighted as potential disruptions. Finally, the auditor's report confirms that, in their opinion, the financial statements present fairly the fund's financial position and performance in accordance with US, generally accepted accounting principles. They've been the auditor since 2016, indicating stability in their relationship with the fund. The tax designations indicate that around 28.72% of distributions were qualified dividend income and 13.46% qualified dividend income. This gives shareholders some insight into the tax implications of their investment. So what's my take on this? Goehring and Rozencwajg Resources Fund had a rough year in terms of investment returns, significantly underperforming broad market indexes like the MSCI World. However, their strategy of focusing on gold and platinum group metals and their commitment shown through fee waivers provided some resilience against even worse outcomes seen in sectors like uranium and some parts of energy. The significant inflows of cash from shareholders despite the negative returns suggest that investors still believe in the long-term strategy, likely seeing the current market conditions as an opportunity. The heavy concentration in materials and energy means that the fortunes of this fund are directly tied to the volatile commodity markets. If commodities rebound strongly, this fund could see substantial gains. Conversely, a prolonged downturn would continue to hurt performance. The management's proactive fee waivers are a positive sign of alignment with shareholders. The key takeaway here is that this is a sector-specific fund that requires a strong conviction in the natural resources sector. Alright, that's our deep dive into Goehring and Rozencwajg Investment Fund's annual report. What do you think about the heavy concentration in natural resources and the impact of those fee waivers? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and remember to subscribe for more corporate financial analysis. And don't forget to join our Discord community for more discussions like this. Thanks for watching and I'll see you in the next video.